Hello everyone. Today, we're going to unravel one of the most significant economic events of our time, the 2008 financial crisis. Imagine the global economy as a vast, intricate plumbing system with pipes connecting every nation and industry. Before 2008, there was a widespread atmosphere of optimism. Money flowed freely and prosperity seemed endless. A key driver of this was the booming housing market, where house prices were constantly on the rise. Everyone wanted a piece of the action, believing that real estate was a guaranteed path to wealth. But beneath this surface of prosperity, a dangerous bubble was forming. Let's explore how. To understand the housing bubble, think of it like a stack of building blocks, representing mortgage-backed securities. These securities were bundles of home loans sold to investors. Sounds safe, right? The problem arose with subprime mortgages, loans given to borrowers with poor credit histories. These were the risky blocks, making the entire tower increasingly unstable. Lenders were eager to give out these loans because they could quickly package and sell them off. As long as house prices kept rising, everyone seemed to win. But what happens when prices stop climbing? When the housing market cooled, many subprime borrowers couldn't afford their payments. This triggered a devastating chain reaction, often called the domino effect. As people defaulted on their loans, the value of those mortgage-backed securities plummeted. Banks, which had invested heavily in these securities, suddenly found themselves holding worthless assets. It was like a game of hot potato where everyone was left with a toxic asset. Trust evaporated between financial institutions, leading to a credit crunch. Major institutions like Lehman Brothers, a giant in the financial world, collapsed. This sent shockwaves across the globe, proving just how interconnected our financial system truly is. The crisis led to a credit freeze, where banks stopped lending to each other and to businesses. Economy: factories stopped production, businesses couldn't get loans, and unemployment soared. The crisis quickly spread beyond finance, impacting real people and real jobs worldwide. World maps began to turn red, signifying the global reach of the Great Recession. Governments and central banks intervened with massive bailouts to prevent a complete collapse. New regulations were put in place to prevent such a crisis from happening again. The road to recovery was long and arduous, but lessons were learned. The 2008 crisis highlighted the critical importance of financial literacy for everyone. Understanding these complex systems helps us make better decisions and build a more resilient future. Subscribe to Hot Breaking News for sharp, real-time analysis of markets and major economic shifts.